everyone, and welcome back to the Knowise knowledge series. Today we have a very interesting topic covered for you. A lot of people have come to us, saying that there are a lot of these financial concepts that they're not able to understand. They've heard of these terms, but they find it very complicated. One of those financial concepts is what we're going to discuss today, and that's called fiscal policy. Now, people hear of it in the budget and people hear about it in so many other places, but they really don't know and they find the whole concept so complicated. So today, I'm going to simplify the concept of fiscal policy for all of you. So come to look at it, don't you think it'll be amazing if all of us could really predict where the markets are going for us to make our investments more effective? But predicting the markets is next to impossible. But what we can do is get indications of where the market is heading. Now, those indications they come to us in the form of economic indicators. Now, we have something called as lead indicators. So think of lead indicators as, a symptom that you get before you fall sick. So now there are a bunch of lead indicators, or we call them key economic indicators, which really help us in understanding the direction of the market. Now, some of them are economic growth of the country, fiscal policy, monetary policy, and external accounts. So in this video, I'm going to simplify the concept of fiscal policy for you. Now, like I said, it's a jargon which people don't understand. Now, let me explain what exactly is a fiscal policy. Now, fiscal policy is the income and the expenditure of the country. So the government of a country basically has the flexibility to manage the income and the expenditure to get the desired result in the economy. So first, let's understand where the government gets its income from. So the main form of income for the government is in the form of taxes. So there's indirect tax and there's direct tax. Now first, let's understand what is direct tax. Direct tax is any tax which an individual or a company pays directly to the government. So it's your income tax or corporate tax that you're paying. Indirect tax is the tax that you're not paying directly to the government, but you are buying goods and services and you're paying tax on that, and that particular tax gets passed on to the government. Some of the examples would be your GST or your central excise duty or your customs duty and so on. Now there's also non-tax income for the government, and there's something called as non-debt capital receipts. So for example, the dividend which is given to the government of the government-owned company. So if there's a government-owned company and they are making profits, that particular profit is passed on to the government. So for example, government would get a share of profits from SBI. Also, we have the disinvestment of government companies, which is a big source of income for the government. So all these are the important source of income for any government. So like I had said, in the fiscal policy, you have the income and the expenditure of the country. And we just discussed the income part. Now we're going to discuss the expenditure part. So where exactly does the government spend its money? So if you look at the expenditure, right, it comes in the budget document, and the breakup of that would look something like this. So we have centrally owned schemes and centrally sponsored schemes. Now, centrally owned schemes are basically the schemes which are completely owned by the central government. For example, a development of minorities, Swachh Bharat Mission, National Health Mission, etc. Now, the centrally sponsored schemes are more like a JV or a joint venture between the center and the state, where the center would pull in a part of the expenses. Example, Manrega is a very classic example where 25% of the expenses are borne by the central government. Now, apart from this, the state also has a share in the taxes and the duties which the government gets, which the central government gets. So, all the states are given a part of the share which the central government gets in the form of duties and taxes. Now, apart from that, there are other heads like there's a defense spend, there's subsidies, and there's pension, which is a relatively smaller spend or a smaller spend in the Indian budget. The biggest expenditure by far is the interest payment on the loans which are borrowed by the central government. So to put it in simple words, where exactly does the government spend? One, it's the infrastructure spend. So it could be for schools of higher education like IISc, IIMs, AIMS, or for road constructions, airports, waterways, etc. Then you have the salary spend, so salaries and pensions of government employees like your IAS officers, IPS officers, revenue officers, and so on. Then you have the subsidies spend. So subsidies, think of it as sunk cost. So for example, subsidies given on LPG cylinders or given to farmers, direct transfers to farmers, or women subsidies and so on. Then you have the defense spend, and lastly you have the interest payments, right, for the bonds which are issued in the market. So for example, in 2019-20, the government of India paid 6 lakh crores in the form of interest. In 2020, the principal outstanding was about 107 lakh crores. So now, when you put the income and the expenses together, what happens? What's the ideal scenario? Ideal scenario is that your income should be higher than your expenses. And that's how we run the house, right? Now, what would happen if your expenses become higher than your income? Now, that's where the deficit happens, right? So if you look at it from economics terms, when a country's expenditure is more than its income, we call it fiscal deficit. India as a country is in fiscal deficit. So now the question is, if there's a shortfall, if our expenses are higher, then how does the government manage that deficit? So they do so by borrowing. It's simple, right? I mean, if our expenses are higher than our income and we need the money, what do? We take a loan. So the government also does the same thing by borrowing money from the market by issuing bonds. Now, bonds are issued by the government, and who buys those bonds? It could be individual investors, but mainly it is the financial institutions like banks or insurance companies or mutual fund companies. So now, let's understand how the government can make use of the fiscal policy effectively to stabilize the economy, which would automatically impact the market. So fiscal policy is nothing but the actions which are taken by the government by altering the taxation or the spending and borrowing to stabilize the economy. So now, what are some of the ways in which the government can really, or what are some of the measures which the government can take in times when the markets are not doing well, or say when there's a recession, then what are some of the fiscal policy measures which the government can take? One, direct benefit transfers to individuals. So when this happens, people have more money in hand, which means they're able to spend more money, which automatically generates more demand in the market. Two, infrastructure spend. Now, this is a very important point to understand that every time there's recession, government would look at increasing the infrastructure spend, which would lead to a direct or indirect generation of employment. So, for example, if the government has given a contract of a national highway construction to L&T, now L&T is going to obviously to execute the project hire subcontractors. Now, this is going to lead to more employment generation. Apart from that, there's going to be a lot of resources whose demand is going to go up, for example, steel, cement, electricity, and so on. Now, this would also lead to a lot of indirect employment generation. So, for example, you would have the local chai wala or, the food stall next door, which is going to get benefit out of it. The local road transport is going to benefit out of it. The medical facilities would get benefit out of it, and so on. And then the third measure which the government can take is by reducing the corporate tax. Now, when the corporate taxes are reduced, then the companies have saved up more money by paying less tax, which they can then use to expand capacity. So then, when all these measures are taken, these kind of measures are called expansionary fiscal policy. And whenever the government announces such measures, you will see the markets doing well, in anticipation that the economy is going to revive. So when you see a bull run, it would happen across sectors and across market caps. But now there's also something called as a contractionary fiscal policy. So what exactly is this? A contractionary fiscal policy is when a government reduces its spending and increases the taxes. So why would a government do that? So a government would do this when the economic condition is normal. So for example, they would do it either to bring down the inflation or to bring in a financial discipline at times when the economy is doing fine. Now, see, the ideal scenario is that the fiscal deficit should be zero. Now, to do so, the government would have to reduce the spending in normal conditions. They can actually use this very powerfully and reduce their spending and increase the taxes so that the fiscal deficit reduces. And obviously, the aim is for it to become zero in the long run. Now, this in turn would lead to a reduction in demand because now people are going to spend less and companies are going to spend less. And this in turn could have a negative impact on the markets. So it will only be a particular set of sectors or companies which would do well at times like these. So to conclude, If it's an expansionary fiscal policy, you would have a universal bull run. You will have most of the companies and sectors doing well. But if it's a contractionary fiscal policy, then you will see only a particular set of companies or sectors doing well. And that is why fiscal policy is a very powerful tool that the governments can use to really have a good impact on the economy. I hope this video was useful, and if you've liked this video, if you thought it was simple and easy to understand, please do like it and do share and subscribe. Thank you so much.